Rosa Garcia works two part-time jobs in Houston, earning about $24,000 a year. Until recently, she cashed her paychecks at a check cashing store, paying nearly $50 in monthly fees, plus extra for money orders. With no bank account, she hid her savings in her apartment. Banking seemed expensive, Rosa says. I thought I was saving money by avoiding bank fees, but I was actually paying more without realizing it. Rosa represents one of roughly 7 million unbanked U.S. households. While most Americans rely on basic banking, about 30% of low-income Americans live outside the financial system, according to research by economists Claire Sellerier and Adrien Matray. Their study, published in the Review of Financial Studies, shows a troubling paradox. Those who most need financial tools to build security are least likely to have them. Yet when banking access expands, low-income households experience large gains in wealth and stability. The effect of participating in the financial mainstream is critical, says Matray of Princeton University. Financial inclusion creates pathways to wealth accumulation that simply aren't available to unbanked households. The real cost of being unbanked. Unbanked Americans often cite high fees and distrust of banks as reasons for avoiding them. Yet alternative services are costly. Check cashing stores charge 1 to 5% of each check, and payday loans can carry annual rates over 400%. These costs drain income that could otherwise grow through interest-bearing accounts. Without credit histories, unbanked people face barriers to affordable loans for homes, education, or cars, locking them out of wealth-building opportunities. The banking access advantage. Sellerier and Matray studied what happened when states loosened rules restricting bank expansion between 1994 and 2005. As banks opened more branches, access grew by about 20% in poorer counties. The effect was clear. As banking services became more available, more low-income households opened accounts. Many remain unbanked not by choice but because banks aren't accessible in their communities, Matray explains. The wealth-building effect. Banked households had, on average, $6,900 more in non-housing wealth than unbanked ones, whose average was just $1,245. Access to banking encouraged saving, investment in durable goods, and responsible borrowing. Families with accounts were 56% more likely to own vehicles, key assets that expand job opportunities. With better credit access, they could finance cars and build financial histories that support long-term growth. Resilience in hard times. Financial inclusion also boosts resilience. After job loss, unbanked households were about 50% more likely to face financial hardship than those with accounts. Financial inclusion gives people tools to manage shocks, says Matray. Banked households were less likely to miss rent or bills, helping stabilize entire communities. Supply-side solutions. The research challenges the belief that people avoid banks by choice. Many would join the financial system if services were easier to reach and more affordable. Expanding branches in underserved areas, limiting overdraft fees, and promoting low-cost accounts could help. Technology can also play a role. Mobile banking and financial education can extend access where branches are scarce. If low-income households benefit from financial inclusion but are constrained by limited access, there's room for policy intervention, Matray says. Moving beyond the cash economy. Financial inclusion is more than convenience. It's a foundation for economic mobility. Expanding access helps families save, invest, and build stability rather than depend on high-cost alternatives. Sellerier and Matray's findings suggest that banking the unbanked could strengthen entire communities by improving resilience and long-term financial health. A secure financial future begins with access. When more families can bank safely, they gain not only stability but the opportunity to build lasting wealth and independence.